Increase your wealth by doing this. Banking smarter. Navigating the world of banking might feel like a maze. You're bombarded with a plethora of banks, each offering a different set of deals and conditions. Don't forget about those interest rates and fees, which can get quite tricky. It's essential to read the fine print before making any decisions. But here's the good news. You can make banking work in your favor and boost your wealth. With some savvy strategies and handy tricks, you can save time and earn more money. Get ahead by banking smarter. We'll show you how. Reevaluate your bank. A 2023 Bankrate study reveals that the average American adult tends to stick with the same bank for approximately 17 years. This loyalty often persists when individuals find their bank fee-free or anticipate inconveniences associated with changing banks, as indicated by the study's findings. Greg McBride, CFA, Bankrate's chief financial analyst, advises that staying informed is crucial. The financial industry is constantly changing. New products and features are introduced to increase your financial situation and make your life better. To take advantage of these opportunities, it's important to seek out solutions that align with your financial goals. Review your current fees and look for ways to reduce them. For example, if your bank requires a high minimum balance, consider exploring online high-yield checking accounts with lower minimums to avoid maintenance fees. These banks often offer fee-free ATM withdrawals and ATM networks, providing added convenience to your daily banking needs. To find the ideal bank that suits your financial requirements, turn to Bankrate's Best Banks of 2023. Stop assuming your bank is giving you the best rate. Even though you might think your bank values you as a customer, it doesn't automatically translate to them offering a competitive annual percentage yield, APY, on your money. Elizabeth Buffardi, a certified financial planner at Crescendo Financial Planners in Oak Brook, Illinois, highlights that many individuals assume their bank will treat them fairly and provide the returns they deserve. In the past year, the Federal Reserve has raised interest rates 11 times after maintaining near zero rates for about 2 years. This shift has prompted some banks to boost yields on savings accounts and CDs, creating an opportune time to explore the best rates. With the cumulative impact of rate hikes and declining inflation, leading savings yields are surpassing inflation rates. This implies that your savings can maintain its purchasing power in these accounts, particularly in the current rate scenario. Online banks offer deposit accounts with rates that often exceed the national average. Don't be fooled by a high APY. The APY, or annual percentage yield, represents the yearly interest rate when compounding is considered. Savings and interest-bearing checking accounts usually feature a variable APY, whereas most CDs have a fixed APY. When seeking an account with the highest APY, carefully review the details to determine the duration of the offered rate. A competitive promotional or introductory rate might be temporary, lasting only a few months or a year. Additionally, check for any specified minimum balance required to qualify for a particular APY. Invest in a CD currently. Leading savings and money market accounts can yield over 5% APY, a level not seen in over a decade. In the present rate scenario, 1-year CDs typically offer higher yields than 5-year CDs. It's important to note that CDs might demand a higher minimum balance than a savings account, and early withdrawal may result in penalties, impacting both earned interest and possibly some principal. If uncertain, consider opting for a liquid savings or money market account. Plan your bank visits. Making a plan before heading to the bank for non-urgent matters can ensure you get the assistance you need. For tasks like applying for a mortgage, scheduling your visit when a mortgage specialist is available can save time. Additionally, consider online transactions for added convenience. When calling the bank's customer service for routine matters, choosing off-peak hours can help minimize wait times. Inform your bank if you plan to close your account. When emptying your account, don't assume it will close automatically. Reach out to the bank to ensure proper closure. It's essential to transfer automatic bill payments and incoming payments like direct deposits to a new account before closing the old one. Failing to close a zero-balance account may lead to overdraft charges if automated payments continue, affecting your credit and potentially making it challenging to open new accounts. Don't close your account too soon. When closing a bank account, reasons might include relocating, opting for an online bank, or finding better rates elsewhere. It's crucial to check if there's a penalty for closing your current account. Some banks impose fees for early closures, like KeyBank and Regions Bank, charging a $25 fee if closed within 180 days of opening. Reading the fine print helps you make informed decisions, allowing you to avoid closure fees by waiting until the specified time frame ends while considering a new account elsewhere. Keep your money in multiple banks. Maintaining accounts with both a physical bank and an online bank can provide a well-rounded banking experience. Many individuals prefer traditional banks for in-person assistance and access to extensive ATM networks. However, it's important to note that traditional banks may not offer competitive yields, often providing a standard APY of 0.01% on savings accounts. On the contrary, online banks have the potential to offer over 5% on high-yield online savings accounts, making them a valuable addition alongside a branch account. Don't allow an unused card to close. It's not uncommon to have a credit card that sees infrequent use. However, there's a potential drawback to closing such a card, as it could impact your credit utilization ratio, potentially leading to a lower FICO score. Some banks might close a credit card if it remains inactive. To avoid this, consider setting up recurring charges on the card, like insurance payments or gym memberships. Similarly, if you find yourself using your debit or ATM card less frequently due to the decline in cash-only transactions and the desire for credit card perks, making occasional purchases or withdrawals every few months could help prevent the bank from closing the card. Use your bank account. Banks might close your account if you're not using it frequently, and they might even hit you with a dormant account fee. To avoid this, it's generally a good idea to make at least occasional use of your account, like a transaction every couple of months. Don't underestimate the impact of regular, small deposits into your savings account. They can accumulate over time. If you discover that your bank account has gone dormant, there's a chance it could be deemed abandoned or unclaimed property, depending on your state's policies. Make sure your bank has your current address to stay in the loop about any inactive account concerns. Money left sitting in an old account might not be keeping up with inflation, and there's a chance it could be incurring dormant or inactive fees. Notify your bank when traveling. When you're on vacation, the last thing you want is a declined transaction. Banks have different policies, so it's a good idea to play it safe and inform your bank about your travel plans. Many banks allow you to report your travel details through their app, or you can simply give them a call to share your travel dates and destinations. Start budgeting. Understanding how much you spend is crucial for reaching your savings goals, and a budget serves as your roadmap to get there. By crafting a budget and examining your expenses, you can identify areas to cut back, like recurring payments for services you no longer need. Those subscription fees and automated purchases can accumulate along with annual fees. To kickstart your savings on a budget, try using Bankrate's Home Budget Calculator. Just input your income and spending to get started.